Stop the recording. Okay, welcome everybody. Thank you for joining us. Thank you for taking our time to be here. We appreciate your time and investing that time here. So let's look at what we have. Well, gold is okay. So let's just start from the very beginning. What we like to just remind ourselves about that we should always ask 3 questions before we take any trade. 3 questions, very important questions. First one, what did price do overnight? Where is price now? And what must I see price do before I execute that trade? And the whole purpose, the whole reason why we're asking these 3 questions is because, don't mind my drawing there. The main reason why we're asking these 3 questions is because we want to have a repeatable process. We want to be able to approach the market in a consistent manner, a consistent, repeatable process so that every time we come to the market, so for instance, if you're looking for break of structures, you're always using your break of structures as your process and that you are not deviating from that. And with that, you're able to measure what you are doing. You're able to have a measurement to be able to say, okay, this week I traded only break of structures, and these are the number of trades I took. These are the number of stop outs. These are the ones that went to take profit. Where can I improve this? So when you can measure something, then you can improve it, right? But when you are not able to measure it, then there's no way for you to know whether you can improve it or not. So therefore, we have these 3 questions. What did price do overnight? Where is price now? And what must I see price do before I execute a trade? So London session has happened already. So let me remove all these lines here. If I can just move this one up here and remove this one. So we'll ask ourselves the question, what did price do overnight? So we can see, so overnight, price started from somewhere there. Well, it gapped down, went up, came back down, right? Nice break of structure there, pulls back down, push back in there. Nice break of structure right there. It gives us a nice kangaroo tail there, and it's gone all the way up. It pulls back down a bit, and it's gone back up. Now it's coming back in here, right? So now what do we expect? As long as price does not close below these lows here, we'll be expecting price to go back up. Why is that? Because we have a break of structure. Yeah, is it a break of structure? Yes, actually, we have a break of structure right there, right to the top side. Okay, so we have a break of structure to the top side, and then we can put our line in the sand right below these levels here. Okay, like I've told those in the inner circle, gold is moving very wildly now. It had the range is very big, right? So if you can stay away from it, that would be good. I mean, look at this now. Just this one move here. This is almost is that yeah, this is 200, 300, 400, 500. That's like 700 pips, right? You are getting trades, your stop loss will be like 1,000 pips and somewhere in that range, right? So it's really very wide. It's very wide. If your account cannot take it, please do not trade gold. Look for other pairs to trade. Okay. So let's go to the next one there. This is pound JPY. So what is pound JPY doing? Oops, let's remove this one. Okay, so what is price doing right now? So price overnight, price went up, came back down, went up, came back down, went up. Nice break of structures there. And then it's pulled back up to this zone here. It's actually done a small market shift there, but let's see. Okay, so now we're expecting price pull back in here. I'm expecting actually that given that it's done the market structure shift, I'm expecting it to pull back up. But will it do that? It may not do that, right? So I have my line in the sand. Let me just give it this zone here, right? Let's see what happens. If price breaks below that low there, okay, if it breaks below this low, then we'll see whether it's going to go further down. right? Mind you, it's giving us a nice engulfing candle here, right? So remember, just as a reminder as well, remember we have three types of setups. We have break of structures, we have market structure shifts. Oops, sorry, market structure shifts. And then we have the rejection candles, right? You can decide for yourself that, oh, I'm only going to be trading rejection candles, or I'm only going to take market structure shifts, or just taking break of structure. So you can take any of them, or you can take a combination of them, right? And the thing is that you never know which one is going to work, right? You never know which one is going to, let's not put it as which one is going to work. Let's say you never know which one is going to play out in the way you expect it to play out, right? So, for instance, this morning, we had a nice break of structure there. And then the next thing we're expecting was for price to pull back, be within this range because it was the last opposite candle, and then come back down, right? That's what we're expecting. However, the person who is looking at all the three setups, right, that we're looking at, the person will have seen this one and say, this is a nice bullish engulfing candle, which is a rejection candle signal, right? And just taken that trade there and just ride it up all the way there. Is there any guarantee that this will happen? No, there's no guarantee that that will happen, right? Because I think sometime last week, let me see if we can find it. Price did something like that to, okay, well, it gave us this one. Okay, there was one that it did not work out at all. Okay, yeah, so look at this. This was last week. When was this? Last week, last week, Wednesday, right? Look at this. Nice bullish engulfing candle. In fact, you had a kangaroo tail, bullish engulfing candle. So you enter right there, you're expecting price to go up, and eventually it came back down, right? So you never have a guarantee what will work or what will not work. What you have, the only guarantee you have is that you will get a setup. Now it is left to you to decide, will I take this setup or not? Right? That is why we have those three questions that we look at. Decide for yourself, what do I want to see price do before I execute a trade? And then once you have that decision, then the decision is made for you. You can then take that trade setup. You can say to yourself, okay, I know this price is coming down right now, so I'll only be looking for sales. Okay, so you just ignore all these other ones as long as it's still within that range, right? You just ignore all those sales. But is there a potential that price could actually move up? Yes, there's a potential. So you can say, okay, I'll take this buy right now. Or you say, okay, I won't take this buy right now. I'll wait for it, let it break above this level again. Then I'll wait for the pullback and then take the trade, right? You can't decide that. So there are 1,001 ways to do these things, but you just have to know which process are you going to take, and are you okay that if you take this buy here right now and then price comes out and stops you out, you're okay with that, right? You have to be okay with taking losses and okay as well with taking profits, right? You have to be okay with those. Okay, so let's look at what is happening on the other pair. That's Euro JPY. Okay, so Euro JPY, what is happening? Let's remove this. Overnight, what did price do overnight? Went up, came back down, went up, came back down, went up. Eventually, nice break of structures. This one is still within that range, right? Still within that range. And what has happened? Price has pulled back, and it has not given me a nice signal that it wants to go back down, right? But it's come back down, done this, and it just, you can see even in the kind of candles we are getting, right? You can see a lot of hesitations, right? Look at all these candles. So look at this. This is a nice bullish candle here, right? Another nice bullish candle. But look at all these very small, tiny candles telling us that price is trying to decide what he wants to do. So there's no clear direction yet on what he wants to do, right? If you compare this to your pound JPY, right? If you compare this to your pound JPY, look at this. It's giving you nice move up, right? It's coming back down. At least the candles still seem to be a little bit bigger than that of Euro JPY. Okay, so I'll prefer to trade this one as opposed to trading the other one, Euro JPY, right? So let's just wait and see what this one would do. But if you must take something, so if you say, okay, I want to look at this, I'm looking at price has given me a nice bullish engulfing candle. I'm seeing that price may actually just go back up, right? So I'll put my line in the sand right here and say, okay, I'm willing to take a buy from down here. If particularly if this one closes like as a nice kangaroo tail, right? I'm willing to take a buy from there and see if it come back up to this level first, pull back, and then maybe come back up to this level and then eventually go to the highs. Okay, so you have a number of options that you can look at, right? And of course, you say this is your line in the sand. If it breaks below that low, if it breaks below this low, then you want to see if it is going to come back down to these lows. You may even say, okay, I want to wait for it. Let it break below this major low here first before I'll be interested in taking a sell. Okay. You can say you want it to break below that lows. Right. So the number of one, there's no need to rush on any trade, on taking any trade. Just wait for it. Let it give you that setup. Let it answer that question. What must I see price do before I take an entry? Let it answer that question that, yes, it has done what you want it to do, and then you take the trade. And remember, all we're looking for is either we see a break of structure, a market structure shift, or a rejection candle. Any of those three, and then you take it and you're off with it, right? Beautiful. Let's look at Euro Aussie. No, sorry, Pound Aussie. So Pound Aussie is in a big, what's this? Wow, this is just a big sideways movement. I can't see much here. So I can just see it just moved up, came all the way back down. So it's just giving me a big sideways movement. So let me remove this one here. So I can even shift this one up here. So what do I expect? Right? I'm expecting, well, this is, in fact, this is something interesting here. So it's giving us some rejection there. And it looks like this one may end up being a bullish engulfing candle. Would it be okay to take a buy, after that, right? To go up? Yes, it's okay. Or will it be okay to just wait? Let's see if it's going to break below and then go below. Yes, it's okay. So you need to take that decision that, okay, this is how I'm going to trade it, and stick with your decision. And the good thing is that you can appropriate your risk, right? So if you're trading, if you say to yourself, I get, for instance, 3 trades in a day, divide your 3 trades by the number of risk you are willing to have per day, your maximum drawdown, right? If your maximum drawdown in a day is 3%, you can say for each trade set up, you just give it 1%. Or if you're not willing to give it 1%, give it 0.5%, right? And if it's still too big for you, reduce it even further so that you can take as many trades as you want, all still within the proper risk management, right? So it's not about just the setup this time around, but you're also looking at the risk management side of things so that even if you get stopped out, so for instance, if this closes as a nice bullish engulfing candle and then you take a buy, you put your stop loss right there. If price goes up, good, well done. If price comes back down and stops you out, well done. You've done what you needed to do. Price has given you that break of that rejection candle and you've taken it, right? But what you have done is that you've taken 0.5%, right? Of your risk is 0.5%. So that gives you the opportunity to say, okay, price has now broken below these lows here, right? It has broken below these lows here, and then I'm willing to now take another sell from right there and then go back down. So I take another 0.5% there. That is the way to trade. Instead of taking, let's say you're risking, if your account, you're risking, let's say 10% of your account here, right? You take 10% here, you get stopped out, you take another 10%, you're already down 20%, right? That is not good at all. That's not how to trade, right? You have to take, and you have to look at it from a long-term perspective, right? It's like in normal investing. When you start investing, maybe you're investing in stocks or investing in real estate, or whatever vehicle you're using as your investment outlay, right? You're not just looking at the next 2 weeks. You're looking at 5 years down the line. You're looking at 10 years down the line. You're looking at 50 years down the line. You want the thing to compound and give you some real good profits, right? So this trading is not running away. As long as there are human beings and as long as one country is willing to trade its products and services with another country, there will always be opportunities to trade, right? There will always be opportunities to trade. So no fear about this one running away anywhere. So you have to look at it from that long-term perspective to say that, okay, if I take a trade here, if I get stopped out, that's fine. Look at it that 10 years down the line, would you be bothered that you got stopped out on this tiny 0.5% here? Right? You won't be bothered because by that time you've compounded your trades. If you've been trading, you've compounded your trades. Even let's not even look at 10 years. Let's even say 6 months down the line. Because trading you can really compound your trading 6 months down the line, 12 months down the line, as long as you're consistent and you're using a repeatable process. That's the key here, right? That's the key here. Okay. We are giving us some of the gems that we have in our inner circle. So well done to you all. Okay. So that's that for this one. Let's look at the next pair. Which pair is this? Euro USD. Oh, wow. Okay. So Euro USD, I mean, you can look at it to see this is just a whole lot of back and forth. Nothing much here. Nothing much here. It's beginning to break that level now, right? So this is range. What did price overnight? This is a big range. What do I want to say? I want to see this break of structure. Yes. Okay. So I want to see if after this break of structure, I want to see if price will pull back and then that's on the next candle, right? Just pull back and then goes down. Where will I put my stop loss? I'll put it above this high here or maybe here too, right? And see if it will come back down. Can price decide that, okay, yes, I've done a break of structure, but I'll just go down a little bit and then begin to come back up. Yes, market can decide to do that. We don't have control over that. All that we have control over is our the type of entries we're taking, where we're putting our stop loss, where we're putting our take profits. Right? Do I want to enter this one right now? As it is, right? Well, you can take an aggressive sell. Still put your stop loss in the right appropriate place. Take an aggressive sell and then see if price will go further down. Okay, so it's all dependent on you as a trader to make that decision at all points, right? You have to make that decision. Let's see Euro USD. Good. So Euro USD too. It's yeah, it went above, right? But we can see now that was just a fake out there, right? But so what would have happened? So let's even do the devil's advocate there. Let's see what will have happened there. So look at what market did here. Okay. So the person who is trading break of structures, right, comes in this morning, London session, and then says price is just going sideways. Okay. It's going sideways, up, down, up, down, up, down, like that. Okay. Well, as at London session, it will have been somewhere there. Okay. Let's remove that. It will have been somewhere here. Right. And he's waiting for price to either break the highs or break the lows. Right. So once price breaks this high, he then enters, puts his stop loss maybe below here, or maybe a tighter stop loss there. The person will be stopped out, and that is totally fine. Another person will say, okay, price has just come down all the way to this place. Then because I have a number of entry strategies I'm using, I can see a kangaroo tail here. I can see a nice bullish engulfing candle. I just take that trade. Even though, yeah, I just take that trade and then that goes right up to the top there, right? And it comes back here. You see a doji here, and then you see a bearish engulfing candle there, and then you just take that trade and it goes nicely down, right? Would you always get this kind of setups? No, you won't always get this kind of setups. Is there any way for you to know that this one is going to work out or not? No, there's no way you know. That's why we say that you should break your you must always know each day what is your maximum drawdown. If you say my maximum drawdown is 5% of my account, then the next thing you need to know is how many trades do I typically get? If you say typically I get 10 trades, per day, typically, right? If I get 10 trades per day, that will mean that I will then have to divide my 5% by those 10 trades. That means for each trade setup I get, I'll be doing something around maybe 0.5%, right? So that whether it's break of structure or market structure shift or rejection candles, is all within these 10 trades that you get in a day. It's all within, so it's all within the risk management. It's still under your proper risk management. So you can take as many trades as you have planned for. Where you now have issues is if you say you're going to be trading, let's say 2% per trade. Meanwhile, your account cannot take, for instance, if you're trading a prop firm account, prop firm, typically many of them will give you 5% or some will give you 3% maximum drawdown in a day, right? So you want to break that down into the number of available trades that you have. Okay, so you have to put in your risk management as part of your trading process. Okay, so there we go for this one. Nothing to do here right now. It's already come down to these lows here. We can expect that price can get in here and then decide that, oh, I'm going to just turn around from here, right? Or you wait for it. Let's see if it's going to break below, and then we'll see if we can get a pullback and then just continue going down with it like that, right? So trading, you have to just follow your process. That's why we keep emphasizing it. Your process is more important than whatever price is doing at any point in time, right? Your process is more important than doing that. So let's look at what price is doing on the next pair. USD JPY. Okay, so USD JPY, let's see what is price doing here. Is just a whole lot of okay. Looking at this is just, I can just say this is sideways market in my eyes, right? Though technically, if you have to really break it down, you can say to yourself that, well, this zone here is just a lot of sideways market. So it started out in the morning, a nice push up, push back down, push up again, push back down, push up, push back down, push up here, push back down. Nice break of structure there. It's come back in, push back down. Now it's pushing back up, right? So all this movement is just a whole load of just no clear direction. No clear direction, right? But can you do a granular aggressive trade? Yes, you can. Certainly, you can see here. So if you're on your chart some 1 hour ago, you can say, okay, price has moved up here and started going down, but it's sort of found some sort of support and it's giving you a nice bullish engulfing candle, which is a rejection candle, which is part of our entry setup, right? And then you just take that trade, see if it's going to go all the way, perhaps to these highs here. Okay, so there are 1,001 ways to do these things. There are 1,001 ways to do these things, but you have to take them one step at a time. Don't model up so many things at the same time. Take one thing at a time and then measure it. If you want to say, test it in a week, for instance, for 5 days, 5 trading days, just test one process, 5 trading days. Then the next day, next week, test another process for another 5 days, right? This thing, trading is going to be here for you to trade. And the market is willing to give you as much as you want. However, you must have a process. You cannot come and trade randomly. If you trade randomly, haphazardly, the market will show you what it means to trade haphazardly. You will get some wins, but you'll get some major losses too. Right. So and the more dangerous one is trading randomly and then not even minding the risk management. That will just kill your account immediately. Right? That will just kill your account. We don't want a situation where, for instance, if you have a $1,000 account, right, and you're trading on your $1,000 account, you take a trade today and you decide to risk a lot, and it gives you, let's say, just one trade gives you $500, right? Just for instance, one trade gives you $500, and then you are so happy, you're excited that you've done so many percentage on your account. Then the next trade, you decide to take it again, maybe that gives you $100. Then one day on a Friday, for instance, maybe particularly on an NFP day, you decide to take another trade because you are now on a high. You take another trade and you've lost $3,000, right? It wipes out all this loss, all these gains, and even some more. It's gone beyond your account. Your broker will just close your account, right? So we don't want to trade like this. We want steady growth, right? If you look at your chart, we want steady growth. That's what we want. We don't want up, down, up, down, up, down. We don't want a rangy market growth. No. We want steady growth, right? Okay. Okay, let's see. Do we have any questions? Okay, beautiful. No questions. Beautiful. So we'll meet again tomorrow. Same time, London session and then New York session tomorrow. Thank you all for making our time. And please take these things to heart, and I'm sure we'll do well. Okay, thank you. Bye for now.